Valuation Master Class Show, where you're going to master valuation in months, not years. What are we going to cover in this show? Well, you're going to get a clear understanding of where interest rates are going globally, and also you're going to get an idea of what Trump could do with rates and how it could fire up the stock market. That's the most interesting part. And of course, since this is a show about valuation, I'm going to show you how rates impact company valuations. Welcome to the show. This is an opportunity for us to get out and talk, and for me to talk about things related to valuation. I want to welcome you to have any questions or comments that you may have. But I thought that I would start off today's show talking about interest rates. And interest rates are key in every way. So let's kick it off by just looking at interest rates for a moment. And what you're going to see is, hold on. You're going to see interest rates here that are falling slowly. This chart, if you can't see it, is government bond yields. This is 3-month bond yields. And what we can see is that in the world, all bond yields basically goes from 5% down to about 4.75. So over the past 12 months, we've had about a 25 basis points fall in interest rates. And that means government 3-month rates. In the emerging world, rates are much higher. They started at about 7, and now they're down to about 7.25 or so, roughly. And let's say they started at 7.25, now they're at 7.5. And then finally, developed world has interest rates down at 3.5 12 months ago. And then they went to basically about 3.25. Now, the thing that I wanted to highlight about this is that generally interest rates are slow to move. They're not going to move a lot. And of course, we've had a period of tightening in the US, which led to higher rates around the world. In fact, interest rates are interesting because one of the things about interest rates is that they're a key determination of the valuation of a stock, of a market, of countries, and the like. And so it's an important thing to talk about today to understand what's going on with interest rates. Now, before we go further into this, I wanted to also mention about what's been happening with interest rates. When the Ukraine war started, interest rates really started to rise. And then we also had the case of, I forgot the name, the Silicon Bank crisis. And as a bank analyst, I know all about interest rates. I was a bank analyst for my first 10 years in my career. And interest rates are the most important thing. Interest rates are like the cost of goods sold for a company. Interest rates are the inputs for the profits of a bank. And what's interesting about the interest rate environment is that we had about 15 years or so in the US where interest rates were close to zero. I'm just going to call them government bond rates or Fed rate at zero because it's pretty much where they were. So Fed rates almost zero for about 15 years after the 2008 crisis. And then all of a sudden, the Fed increased interest rates dramatically until we got to where we are now. Well, let's look at where we are. So right now, the 10-year Treasury yield is a global benchmark for valuing assets, and it's about 4%. And there's expected declines in 2006, which could support higher valuations. So the Fed, now, personally, I'm the type of person that doesn't like the Fed at all. And I don't like it for one key reason, is that, well, if you think about it, everything that you buy in this world, here's a clicker for my presentations. Does the government set a price for this? No. Here's a glass I bought at IKEA. Does the government set a price for that? No. Government doesn't set a price for these things. But why is it that the government sets a price for money, the price of money? Now, obviously, we've been sold the story that because the government can set prices for money, meaning interest rate, that they're going to basically set it right. They're going to set it better than the market. Well, I don't believe that at all. There's no way that the Fed or any government institution or quasi-government institution is going to be able to set the market's price for money better than the market. And so already I don't like to see all the manipulations. And it's funny how everybody's a capitalist, but when it comes to the price of money, they all want the government to set it, which is the weirdest thing that I think I've ever heard. But the point is that the Fed now controls the money supply and they control interest rates as best they can. But what they can control is they can control the short-term rate, and that's what they can bring down or raise. And ultimately, they want the 10-year rate to rise or fall in tandem with the rates rising and falling. And so that is what they want. Now, let's now go and look at some other interesting stuff. And by the way, if you have any questions or the like, let me know. Just send me a message. You can send a message in the chat. Also, today I'm gonna share with my viewers a chart book that I created many years ago about interest rates globally. It's pretty long. It's comprehensive. I look at the interest rates every single month across every country in the world. And if you're interested in that chart book, all you got to do is just send me a message here. Just send me a message at me@andrewstotz.com, and I'll send you that chart book. It's only, I don't sell it. I don't publish it. It's an internal document, but you're welcome to request it, and then I'll send it to you. So let's continue on and look at some other factors. Now, before I do that, make sure if you've got any questions, leave a message in the chat. I see we got a message, best wishes for the new show from Lee. Thank you, Lee. Appreciate it. And Lee is definitely looking at what's going on with the Fed this week. So let's now go deeper into that then. What is going on with interest rates in the Fed? So what does consensus say? Well, the Fed is expected to cut its benchmark rate by 1/4 point at the upcoming December 9th and 10th meeting. And this would lower the target range from about 3.75 to 4 down to 3.5 to 3.75. And so basically a 25 basis points cut. Now, even though the Fed's got to rely on incomplete economic data from the October shutdown, and they face significant internal disagreement, but generally we can say consensus is maybe a 25 basis points fall. If that's true, then we can say the market is relatively optimistic. Now, why does it matter? Well, it matters because if the interest rates go down, the market tends to go up. But of course, we know that if interest rates go down in line with expectations, then that's already been adjusted in the market. So the question is, will the Fed surprise this week? And that's really the question that we have to think of. Now, I would say the Fed probably isn't going to surprise this week. They're either going to keep the rate the same or lower it by 25 basis points. I think Chairman Powell basically wants to show that he's not going to be pushed around by Trump, and he is going to lower rates a little bit possibly. And then, that's kind of the compromise. So let's now look at who's next, by the way. Fed Chairman Powell has an ending of his term in May of 2026. And right now, a guy named Kevin Hassett is a clear front runner, and he's expressed his desire for large rate cuts. Now here, I want to talk about what's going on politically and why interest rates and the Fed chairman is so important. And that is this. Almost every president loses seats in the House and or the Senate, let's call it the Congress. Almost every incumbent president in the midterms, so they have 4 years as a president. After 2 years, there's going to be an election for the House of Representatives and sometimes the Senate, but let's just look at the House of Representatives. As a precedent, almost all of them lose seats in the House. Like, politicians really only disappoint. They never, surprise on the upside, and things are much better. So Trump knows that if he loses the House or loses control of the House, he becomes a lame duck and there's nothing he can do. So I would argue that it's critical to get another Fed chairman in as soon as possible to do what Trump wants to do. And again, I don't agree with the government setting interest rates through the Fed, but I know exactly what will happen is that if Trump can get the chairman of the Fed to lower interest rates, that's going to happen. He's going to do it. And when interest rates go down, then that's going to rise. Now, recently, in my all-weather strategy, in the global investment strategy that we have, we've increased our weighting to the US, and part of that is positioning for the potential rate fall that's coming. Now, let's look at some other charts that I think are interesting. Here is the first one, and that is that rates have been falling more in the developed world. So here we can see that this chart shows that if we go back to November of 2024, now all my interest rates that I'm telling you are from end of November 2025. There's been changes since then, but I like to look at it on a monthly basis. What we can see here is that in November of 2024, the world interest rates were at 4.3. And when I say world interest rates, I mean the 3-month government bond yield. And now it's down to 4.9. Now it's down 12 months later to 4.3. If we look at the developed world, interest rates are at 3.6, so below the global average 12 months ago, and now they're at 2.9. So there's been a fall, but what you can see is that emerging markets have hardly fallen. They've gone from 6.7 to 6.3. So they've fallen by about 40 basis points in the past 12 months. In addition, interest rates in the emerging markets are double those of the developed market. And this is the type of chart that I have in the chart book. So I want to talk a little bit about what's happening with interest rates. Why are developed market interest rates so low and emerging market rates so high? Well, the answer to that is that the US and other developed markets have the ability to basically drive down interest rates, and by issuing debt, which they've done a lot of. And what happens is that unlike emerging markets, if emerging market, let's take Thailand as an example. Let's say that Thailand decides that it wants to, let's say, lower interest rates. And when it does that, the attractiveness of the Thai baht relative to other currencies will fall. It'll become less attractive. And that will cause people to move money out of the Thai baht and into other currencies. And when that movement happens, it's going to cause a depreciation in the Thai baht. So there's a natural buffer for smaller countries and emerging countries. It can be also, smaller developed countries, but let's just say smaller emerging countries have a problem, and that is they're dealing with the free market. You see, the developed countries they've got a rigged market. People are using their currencies for transaction, particularly the US dollar. And then, of course, the US has all the military might. They also control the global financial system. And so the result is they can lower rates and still keep their currency strong. And that's what's going on. Now, also, what that means is that during COVID in particular, or after the 2008 crisis, the US lowered rates massively. Why is the US performing so well relative to other markets? Well, one of the reasons is they've had almost 20 years of super low rates, the 15 years after 2008. And then, okay, it's come up a bit, but I think it'll come down. So let's say they had 15 years of very low interest rates. Emerging markets couldn't afford that. And so that's a big difference between the developed markets and the emerging markets. Now, if you got a question about it, let me know. All right. So the advanced companies have ability to drive interest rates. Yep. Yeah, the countries, correct. Trump is getting all his doves in a row just in time for the midterms. Yes, his ducks in a row, correct. And interest rates can change the entire story. Quite important. Exactly. So now let's go to the next thing that I wanted to talk about, and that is this chart. Here, I looked at what are the top 5. I'm talking about developed countries, right? So these are the top 5 developed countries: US, Japan, Germany, UK, France. Of course, US is massive and the others are relatively small. Now, all of the interest rates across the board are falling compared to 12 months ago. So US is fallen from 4.5. This is a 3-month government rate down to 3.8. Germany has fallen from 2.6 down to 1.9. And UK has fallen from 4.7 down to 3.9. And France has fallen from 2.9 down to 2. The only one that hasn't fallen is Japan, which has gone up from 0.1 to 0.5. Now we see the Japan long bond, let's say the 10-year bond as an example, rising even much more than that. But these are the interest rates that the governments can control. So we can see we are in a falling interest rate environment in the developed countries. And that basically tells us that that's part of the reason why the stock market has been so strong. Let's look at now the next one, which is the main emerging markets. So I've talked about emerging markets. The main emerging markets are China, India, Korea, Russia, and Brazil. Now you may say, Andrew, why is Korea an emerging market? Well, when I talk about emerging markets, I'm talking about the MSCI classification, which is a classification used for investors and the market. That's why we call it emerging market, not emerging economy. Someone may say that Korea is a more advanced economy, but when it comes to market, it is classified in the emerging markets because of restrictions related to investing in Korea. All right. What we can see here is that the Chinese market, basically government bond yields have been flat at 1.2%. What's happening in China is inflation is falling, and basically China's slowdown over the last, let's say, 18 months or so is reflected in very, very low interest rates. Now, India has gone down from 6.7 down to 5.5. And it's one of the few countries that's falling in interest rates. And then Korea is going from 2.9 down to 2.3 over the past 12 months. Meanwhile, Russia is very high for 3-month rates at 22.3, which is the same of where it's been over time. And then Brazil is raising rates from 12.4 to 14.9. Now, it's interesting about Brazil because the market has been somewhat attractive. And we've been looking at that market and allocating some money to that market. So what's happening there is, of course, part of why an emerging country like Brazil, as an example, is raising rates is because they may be trying to protect the currency or other things. But to see their rates rising when they're a major exporter is a challenge, right? And so I haven't looked into Brazil in that much detail about the history of its rates, but I can tell you it's definitely been high and volatile. So that gives us a little bit of a picture of the 5 developed markets and largest developed markets and the 5 largest emerging markets, which can give us a picture of what's happening with interest rates. So let's continue. I have another chart that I want to show you. Again, these charts all come out of the chart book that I've created. And if you want a copy of that, just send me an email at me@andrewstotz.com, and then I'll send you a copy of that. So let's go back and look at one more chart. This is the final chart of what we'll look at. I was looking at developed countries only, and I was trying to figure out, okay, which countries had the biggest falls. And here we can see that New Zealand, Singapore, Hong Kong, Canada, and Austria have all had very significant falls in their interest rates relative to all the other countries. Hong Kong and Singapore are pretty much, most of these countries are tied to the US dollar. So they're naturally going down when the US dollar is, when rates of US dollars are going down, they're going down. But that gives you a picture of the developed markets that have seen the biggest fall in rates. And those falls in rates have, supported their equity markets. And if it continues, where they're falling more aggressively than other countries, it could continue to support those markets. The next thing I want to look at is, hold on, let's see. Now here, what we can see is now I'm looking at the trend of the 10-year bond yield for the top 5 developed countries. And what you can see is that basically they're either flat or up, except the US. The US 10-year government bond rate has been falling since about July. July was, so it started falling in August and then continued its fall. Now that fall is very small, from about 4.2 to about 4. But still, that tells us that US is kind of leading the charge on lowering interest rates. And remember, 10-year bond rates are not set by the Fed. 10-year bond rates are set by the market. The Fed can't really control the whole market. And so what you can see is the market is expecting lower rates. It's important to think about rates in terms of valuation. Whether you're running a company or whether you're investing in a company, it's significant. And the reason why it's significant is that basically there are many companies out there that are borrowing a lot of money. And let's say that they're borrowing money safely. They're doing a good job. They're borrowing the money very carefully. But this would mean if interest rates come down, that what we would see is that interest expenses would come down. And what would happen? Profits would rise. And this is one of the reasons why we look at interest rates and think they're pretty significant. Now, small changes don't have a major impact. So what I want to now do is tie this all in and bring it together into why this matters for valuation. So from a fundamental perspective, if interest rates fall, then interest expenses fall, which could boost profit. So that's the first reason why stocks tend to rise when interest rates fall. The second one is related to valuation. And that's basically means that we also lowering rates raises stock valuations by reducing the discount rate in financial models, which increases the present value of future earnings. And then the final one is relative valuation. Lower rates also reduce the relative appeal of bonds, encouraging a portfolio shift of investor capital into equity. Bonds are less appealing as the rates go down lower and lower, and so people switch into equity. Now, I just wanted to talk about one thing that's interesting, in my view, from an investment perspective, and that is, what is the possibility that Trump lowers interest rates to close to zero? Market's not expecting that. That's not in the Fed, consensus right now. But let's just think it through for a moment. Why would Trump want interest rates to go to zero? And again, when I say zero, I'm saying the Fed brings interest rates down to, let's say, 0.5 or something like that. But let's just call that zero because it's just incredibly low. Why would Trump want that? Well, the first thing is that he can argue inflation's under control. We don't have a problem with inflation. Part of the reason why inflation is under control is because Trump has driven down the oil price by saying he's going to drill and other countries are going to drill. And so the result of that is that the pressure on prices has come down. Now, there's many other ways that price pressure could be rising, like if a lot of workers are leaving America, that could push up prices of wages. That could push up wages for companies. But what's interesting about this to me is that if Trump was to push to lower interest rates, which is the reason, what he's pushing Chairman Powell to do, and I'm sure that what he's going to do is pick a guy like Hassett or others that are going to lower interest rates. Why is this so important? It's so important because we're going to face the midterms. The midterms come in November of 2026. By November of 2026, the market, the stock market, the economy's got to be doing well, or else Trump's going to lose seats in the House. And if he loses seats, he could lose control of the government, and then it's over. He can't put his things into action as well. He won't have the House of Representatives behind him. And so I would argue that it's a huge thing that he wants to do long before the election, which means even that May, or I think it was May that, what did I say there? Let me just check. Was it March? I can't remember. Yeah, May. May is a long way to go to get to falling interest rates. And that's part of the reason why I think Trump is trying to put so much pressure on Powell in hopes that he gets out so he can put someone else in that can fire at the market. Now, you may say, oh, yeah, that's Trump and that's, typical, of his style. Well, wait. Remember what Biden did before the midterm during Biden's period as president? You remember that? What did he do? He released the Strategic Petroleum Reserve of the U.S., and he basically dumped a huge amount of inventory of oil that the U.S. had onto the market. And what did it do? And he did it probably 4 months before the November election in 2022, I think it would have been. Can't remember. But what he did is he dumped that on the market, which immediately pushed down oil prices massively, which is the biggest lever that you have for inflation. There's nothing else that will impact inflation so much as oil price. So again, we may see, Trump continue to push on oil. And so what I would argue is that between oil and interest rates overall, he's going to be pushing down inflation as much as he can, and then encouraging the Fed chairman to lower interest rates close to zero. And when that happens, what's going to happen to the US equity market? When short-term rates cut by 50%, they cut by half, let's say they cut in half, the market's going to fly. And that's part of the reason why there's some strength in the market. And I would argue it may be worth it to have some position in the US market. Now, let's just see if we got any questions or any comments, right? Yep. So here we can see the higher, Deborah says, the higher the rate, the higher the interest expense. Correct. And if we have interest expense rising and rising for a company, it can be really difficult. And so he will also take pressure off of companies that are struggling in that way. Well, for those of you that want to get that chart book, let me just pull that thing up again. Just send me a message at me@AndrewStotts and I'll send it to you. And then I just want to thank you for joining and listening in. Today, this was a discussion about mainly interest rates and the impact. Let's go back to what I said at the beginning. What are you going to get? You're going to get a clear understanding of where interest rates are globally. I think we went through that and we saw that. You're going to get an idea what Trump could do with rates and how it could fire up the stock market. And then you're going to see how rates impact your company valuations. And we saw it affects them through the fundamentals, through the valuation, and the relative attractiveness of equities relative to bonds. That's it for Valuation Masterclass Show. My goal is to help you master valuation in months, not years. My name is Andrew Stotts of Valuation Masterclass, and I wish you have a wonderful day ahead.